Now we are quite clear about these things. We learn about these things in first chapter, but let me give you a summary and we can continue from there and we will study what is the cost of capital basically means. Um, when a business look for finance, I'm talking about long-term finance. So you have these two options we discuss in detail. But keep in mind, when you're looking for finance, when you're looking for funds for investment reason, for expansion reason, for any reason, keep in mind why they will give you money, why the equity holder give you money, why the bond holder give you money, why the bank will give you money, because they want what? They want return. No one will give you money for free, right? So keep in mind, money, when you arrange from any source, it always has a cost, right? Definitely it is return for them, but it is cost for us. That's why we call this cost of capital. Okay, so when you finance money through equity, they look for dividend or they look for capital gain. I hope you know capital gain is a share price increase, is a capital gain. Okay, a shareholder can get a return, can get reward from its shares through two main sources, either by receiving dividend from the company, or if the company share price um, grows, moves up, it's also a return for me. On the other side, the debt, the banks, banks and the bondholder, they look for interest. So this is the return for them, and for the company perspective, it's cost for us, right? And we discussed already which one is expensive, which one is cheaper. So cheaper, why? That is cheaper always. So we discussed in first session that whenever you are looking for finance, your first priority is always debt. Reason is because debt is cheaper. There are three reasons, by the way. From there we can understand that why debt is cheaper. Number one, the debt holder, the bank, the bond holder, they are facing less risk. Why? Because they will receive their promised return, the promised interest, and in case of liquidation, they will get their money at first. So in both cases, they shift all the risk to the company. Okay, so because they are bearing low risk, so they are ready to invest the money, finance the money, provide the money, lend the money at low rate, right? Number one reason. Number two reason, tax savings. Debt mean when you borrow money, you have to pay interest on it. Interest is a allowable expense for tax purpose. Mean when you pay the tax, you can deduct your interest amount from it. So what happen? Interest will reduce your profit. As your profit will reduce, your tax will reduce. So you will get some tax saving due to that. Right? Number second. Number third is issue cost. Normally debt have a lower issue cost as compared to the equity finance. Equity is the most expensive way of finance, normally the public issue, right? So why they're expensive? Number one, the equity holder, they're looking for high return because they're being the high risk, number one. Number two, the dividend that you pay to them is not tax deductible, so you will not get any tax savings on it, right? And number three is the high issue cost. Yes. Cost of capital is the minimum return that you must need to achieve in order to satisfy your investors. Yeah, it's a minimum that we need to bear. You can say that. It does not mean essentially we have to give it to the owners of the shareholder. This is a minimum return they are looking for. So we can raise money through equity, or we can raise money through debt. We have these two options available for finance. So what is the equity? When you raise money through equity, they expect return from us. This return for us is cost, and we call this cost of equity. So what is the cost of equity? So, okay, dividend is return for them, or capital appreciation is return for them. But for us, it's cost. And we call it cost of equity. So what is the cost of equity? Cost of equity is the minimum return Cost of equity is the minimum return that shareholders are looking from you. They will only satisfy with you, they will only stay with you if you give this minimum cost of equity. And we calculate this always in percentage. Similarly, the return which is expected by bondholder or which is expected by the bank's interest, for us, this is called cost of debt. So the cost of debt is the minimum cost that we have to give to our loan provider. Any loan provider. We discuss all of them. And when you combine them, this is called cost of capital. So the cost of capital, look, cost of capital is basically sum of both, right? So cost of capital is the minimum return that you have to earn or you have to provide to all your investors, right? Cost of capital is the average basically return that basically you find the cost of equity, we will learn today, and then we find the cost of debt, we will also learn today. And once you calculate these both, you will average them. How you will average? Let's say, look, let's say you find your cost of equity and it is 10%. Let's say you calculate and it's 10%. You calculate your cost of debt and let's say it is 6%. Normally cost of debt is cheaper. We know that. Debt is cheaper. So cost of debt is always lower than your cost of equity. Okay, then what we do after that, once we find our cost of equity and cost of debt, then we will find out our capital structure. Capital structure mean, okay, you raise funds in your business, right? So how much percentage of funds you raise through equity? How much percentage of funds you raise through debt? Simple. I mean, let's say currently you have 10 million of capital structure or capital employed. Normally we say the word, which is word is equal to debt plus equity, right? So you employed 10 million in the business. Out of 10 million, 6 million comes through equity and 4 million comes through debt. So what is the weightage? 60-40. Okay. So we have to find these costs and we have to find the weight, the capital structure. Let's say I'm saying the capital structure is how much? 6. Okay. 60% and 40, let's say 40%. Yeah. I mean, 6 million we finance through debt, through equity, and 4 million we finance through debt. So in that case, the next thing is what we have to do, we multiply both and we find the weight of both and we add the both. Okay, so to find the cost of capital, what should we do? We multiply 10% with 60%. I think you will get 6%. 10%. Okay, so 10% into 60%, you will get 6%. Okay, 6% is the weight here. Sorry, 6% is the weight here. And 6% into 40%, I think is 6 4s are 2.4%. 2.4%. So your cost of capital is 6% plus 2.4% is 8.4%. So what is your cost of capital? Your cost of capital is the average of your equity, cost of equity, and cost of debt. When you average them, we call this cost of capital. And we also call, because this is the average, right, of these both. So that's why we also call it the commonly used term. We call this weighted average cost of capital, or in short, we call this WACC. Okay, let's start with the cost of equity. Let's start with the cost of equity. What is the cost of equity? Okay, cost of equity is the minimum return that we have to provide to our shareholders. Okay, to find the cost of equity, we have two methods. One is dividend valuation model, and the second one is capital asset pricing model, CAPM and DVM. What is the dividend growth model, a dividend valuation model? Here we have assumptions. What assumptions? That the investor, look, basically we need to find what is the cost we are giving back to the shareholder, right? What do we give them? Dividend. Okay, so we, by using the dividend, we want to determine how much return we give them. And look, what's the formula here? The common formula is this: D0 or D naught over P naught. D naught is basically the dividend you pay right now, and P0 mean is the market price of the share of our company today. Will give you the cost of equity or shareholder return. Look, all model are based on certain assumption. So dividend model, DVM, dividend valuation model, is also based on an assumption. It has two assumptions. It assumes, let's say a company pay constant dividend in perpetuity. By the way, you know, it's not happen in reality. A dividend is the decision of the management. The director will decide they want to pay any dividend or not. Look, the original formula basically that is available in your formula sheet in the exam was this: PO is equal to DO over RKE. You know what is the perpetuity formula? 1 over R. 1 over R. Basically, we are taking the dividend and dividing with 1 over R. Why? Because we assuming that we are giving same return to the shareholder, same dividend to the shareholder in perpetuity. And what it gives me, what is this? Value of the share, market value of the share. Look, there are many ways to find the value of share or value of anything. By the way, we discussed the business valuation section in detail. Look, there are many ways to find the value of anything. The best way to find the value of something is considering all the future cash flows. I mean, if I have a machine, I want to know what is the value of it. So one way of valuing it, okay, how much life it is? 10 years. How much cash it gives me in 10 years? Cash inflows. Take all of them and discount them. So the present value of future cash flows is best market value. The best value of this. You can say is a more reliable value of this asset. Similarly, if you have share, best value is how much cash flows it generates to us in future. So if we assume that you are going to pay the same dividend in future, in perpetuity, take the dividend amount and discount it. 1 over K is discount rate. In perpetuity, you will find the market value. This we will use in the business valuation section when we will come to know the value of shares. So we basically reverse it and find this. So if you have given the price of the share, if you have given the dividend of the share, just reverse it and find the cost of equity. Right? Understand? Now, I hope this point is clear. Now, just let me raise few more points and then we can start doing the questions. Look here, the PO, the price of our share that I'm going to use, it should be ex-div. Ex-div means excluding dividend. Look, when a company announced that we are going to pay dividend, this normally the price go up because the expectation is the dividend is going to come. Normally the price goes up. This is known as cum div share price. In cumulative of dividend share price. Let's say it's $4. Let's say per share. The dividend announcement you made is, let's say, 50 cent per share. Look, the dividend you announced is 50 cent per share. Once the dividend will be paid, because the dividend paid, so investment reduced, right? So the worth of company will reduce because company pay off money back to shareholder. So the company share price immediately after the payment of dividend will fall exactly with the same amount of dividend you paid. Right? So what will be the ex-div payment amount? 3.5. This is the ex-div share price. Keep in mind, whenever you're using the dividend valuation model, we always need the ex-div share price. If the cum-div share price is given to you in the exam, or indication of it is given in the exam, subtract the dividend amount to get the ex-div share price. And in reality is almost the same. Immediately after, a second after the dividend amount was paid, the share price will fall with this amount because the money is basically now it's discharged from the company, so the value of the company will fall. Okay, we come to know about this idea in business valuation. For the time being, just keep this point in your mind. Can you please calculate the cost of equity here in this question? A company has paid a dividend of 30 cents for many years. Okay, so that means you're paying the same dividend for many years. The company expects to continue paying dividend at this level in the future, in perpetuity. The company current share price is 1.5. So simple, we can use our formula. So what is our dividend? Dividend is 30 cent. So keep in mind, cent is 0.30 dollar because the price is given in dollar and 1.50. It's up to you. Either convert dividend in dollar or convert your price into cents. Don't make a mistake in the exam. Look, now both values are in dollars, or you can write 30 cent over 1.5 dollar into 100, 150 cent. Okay, what answer you get? Multiply with percentage or 100. How much? 20%. Try this question. Question number 1. The ordinary shares are quoted at $5 per share ex-div. So we already give ex-div. A dividend of 40 cent has just been paid and we expect no growth in dividend. So that means very simple, 40 cent, that means 0.4 divided by 5 multiplied by 100 or percentage. So you will get exactly 8%. Can you find second question answer? No. Look, now here, what's the trick? What he said? Did he mention this price is ex-div? No, he said dividend is about to be paid. Did you pay? No, about to be paid mean you haven't paid yet. That means this price is cum-div. Subtract this amount to find the ex-div price first. So you will do, what is the cum-div price? 2.00. Subtract the dividend payment from it. And find the ex-div price. 1.85 and then use it. Okay. Now, as I said, dividend valuation model has two assumptions. Okay, it is assumed that a company is going to pay the same dividend in perpetuity or dividend with the same growth in perpetuity. What that mean? Okay, either you get, let's suppose you pay 15-cent dividend every year, or 15 cent and 5% growth in dividend every year. So in both cases, okay, examiner will deal with the both cases. Okay, look here. If I show you the assumption here, so DVM states that future income stream is the dividend paid out of the company. Number one, dividend will be paid in perpetuity and dividend will be constant, means same, or growing at a fixed rate. 5%, 6%, 7%, and this fixed rate will be provided, or we have to calculate. What's the growth? Okay, look, D naught into 1 plus G over RE minus G. Look, if you want to include growth, the growth will be given. Okay, if the dividend is zero, sorry, if the dividend has no growth, right, then what will happen? Just okay, for the time being, forget about it. If the dividend growth is zero, then this will become 0 and this will become 0. What a formula will become? P naught D naught over K. So that's the original formula, right? So D naught into 1 plus G. I mean, what's that mean? We include growth. If you growth, that means you will get the next year 1 year dividend. We can also call it D1. Because look, D0, 0 mean 2 days dividend, the recent dividend. When you include growth in it, 1 plus G in it, this will be equal to D1. I mean, let's say the current dividend you pay is 50 cent, right? And then dividend will grow with 10%. So 1.1. That means how much dividend you pay next year? 50 into 1.1. Whatever answer it will get. 50.5 or whatever.
55.
Yeah, 55 cent. We can rederive the formula. Okay, so the formula is this, and we can use it, and using that, we can rederive to this. So that's the formula that we can use to find, assuming we have the growth in dividend, a constant growth in dividend, if we find. Look how we find this. Look, the formula that we learned was this. By the way, this is the formula of annuity, perpetuity with growth. Okay, what's the formula? Remember, P naught is equal to D naught into 1 plus G, right, over RE minus G or KE minus G. So we rederive it and find this. How? Look, I need to find the KE, right? So what should I do? I will take KE on this side, right? And PO on the other side. So what we will get? What we will get? KE minus G is equal to right? I want to find K. To bring key, G on the other side. So when we bring on the other side, it will be plus. That's a formula. Okay, so if he will give you dividend and he will give you the growth in dividend, which formula we have to use? This formula, or we can also call it D1. Maybe he give you D1 itself. Just use it. Don't include any growth into it. Now let's try this question. Yeah, can we do this question? Okay, PCO has just paid a dividend of 10 cent. So the D naught is, okay, I'm going to use this other formula. Okay, so D naught is 10 cent or $0.1. What's the growth in dividend? 7%. So I can call it 1.07 or 1 plus 7%. So we can say it's 1.07 divided by, what's the price? We need X div price. If it's not mentioned something, so the same 2.05 plus G 0.07 and find the answer. 12.2. Okay, let's check. Yeah, so it's 12.2. It's clear? Next. Now try the next question. So just paid, recently paid. So again, same. And the share price is given, growth rate is given. So we have to apply the same formula again. Okay? Okay, so formula we knew. Again, the price is active. It's mentioned very clearly. So 20 cent, 0.2. Growth rate, 1.05. Over price, $4. And plus G, 0.05. So what answer we get? 10.25%. Is it? What is the next thing? The next thing is sometime examiner will not provide us growth in dividend and we have to find out the growth in dividend. But examiner asks us to find the growth in dividend and then find the cost of equity or the rate of return of the equity holder. So we might be tested to find the growth in dividend as well. And to find the growth in dividend, we have two approaches. One is known as Gordon growth method. The formula for this is G is equal to BR. And this formula is also provided in your formula sheet here. The Gordon growth approximation, G is equal to BR. And second method is average annual growth rate method or geometric growth rate method. This formula will not be provided in the exam. Okay, so we will discuss now how, in case growth is not mentioned, we can find the growth. Okay, so I will start with using this formula first. How I derive this formula, by the way, and what is the logic behind using this formula? Look, by the way, we learn one thing. D1 is equal to what? D1 is equal to D0, right? D0 and multiply with 1 plus G. Right? This is a formula. What? How we get? I mean, dividend, D0 is a current dividend. Okay, the last dividend, this year dividend. D1 is the next year dividend. Right? And into 1 plus G. Now, basically, this formula I derive from this basic concept. Look, if you want to find the G, this G from here, So I need to rearrange the formula. Simple. Look, by the way, I would say that let's say this is not a simple stuff we can use for dividend. This is a way to find the average growth for everything. I mean, if you want to find what's the average growth in profit, what is the average growth in cash flows, what's the average growth in inflation, what's the average increase in inflation, right? So we can find using this formula. What's the formula, by the way? Formula is what? I mean, any value, dividend, sales, profit. Formula is if you want to find the latest one, okay, latest one is equal to earliest one multiply by 1 plus g. Simple. I mean, let's say the last year dividend was $2, right? And this year dividend grow by 10%. So 2%, okay? So $2 into 10% mean 1.1, right? So it gives you dividend, latest dividend, which is 2 into 1.1, 2.2, right? So earliest dividend or earliest profit or earliest sales, when we add the growth into it, we find the latest sales. Okay, let's say you want to find dividend after 2 years, then 1.1 raised to power 2, right? So formula has to be little bit arranged now because it's 2 years of dividend now, right? It's 2 years of dividend now. So here 1 plus n, 1 plus g, here we have to put the power n. Number of years, because 2 year of growth now, or 1 plus g multiply by 1 plus g. If it's 3 year, 1 plus g multiply by 1 plus g multiply by 1 plus g, or 1 plus g raised to power 3. Okay, so that is a simple formula now we have, which is what? Latest, we are finding dividend now. So latest dividend is equal to earliest dividend into 1 plus g raised to power n. Now, when we rederive this formula, we will find out this formula. Okay, this is a formula I have now. This is a formula we have. So here what we have to find? We want to find g, right? So I need to make g separate. I hope you know the mathematics, right? So if I want to make g separate, what should I do? Look, this formula will not be provided to you. So basically you have to remember this formula, right? Or you should know how to derive this formula. Okay, this is a formula. If I want to find g here, so earliest, first of all, I will keep on this side, right? So it will be what? Latest, okay, latest over earliest is equal to 1 plus g whole power n. Now what? What I want? I want only g, right? So to find the g, now what should I do? What should I do? I will remove the n, right? To remove 1, what should I do? To remove n, I will take like this, 1 over n on this side as well, and 1 over n on this side as well. This will be removed with each other. And now the formula is becoming latest over earliest raised to power 1 over n. Or you can also do like this, like square root n. Same thing. It's same idea, right? Same concept we have. Now, by the way, when I do that, I still find what? 1 plus g. I need only g, right? So 1 I need to take on the other side. So what formula will left? See, is the same formula I wrote here or not? G is equal to latest amount over earliest amount into 1 over n minus 1. Look, this is the formula to find average annual growth or geometric growth for anything, not for dividend only. This is not only specific for dividend. This is to find the growth in profit, growth in sales, growth in anything. So one way that we can use this formula is to find the growth. Now here, First of all, we have to find the growth rate in dividend, and then we have to find the cost of equity. Can you calculate this? So look, you can either use the same formula or you can use the direct formula and just put the numbers over there, right? So the direct formulas we know. The formula we have is latest over earliest. Okay. So latest information over earliest information. This is the formula, right? So what is the latest dividend here? He said paid a dividend of 20 cent per share 4 years ago. This is the earliest dividend. Okay. And the current dividend is 33 cent. Okay. So you can take in cents or you can take in dollars, up to you. If you want to take cents, then both should be in cents. So 33 cent is the latest dividend and 20 cent is the earliest dividend. How many years? 4 years earlier we have -1. That will help you to find what? To find the growth in dividend, and you will find around 0.1333 or 13.33%. Right? Now you find it. Now you use a formula and find the cost of equity. Okay. Now use a formula and find the cost of equity, which is what? KE is equal to, which is what? KE is equal to, okay, so cost of equity formula now we have to use. Formula is what? D0, the current dividend, right? The latest dividend we paid, 33 cent, which is 0.33 into growth that we find 13.33 or 1.1333 divided by P0, which is 6, and then in the end you will add again 0.1333. Okay, I don't have space here, so plus 0.1333. So what answer you get? Same answer you're getting? 19.56%. Okay, that's the other way to find the growth in dividend. So one way of finding the growth in dividend is a geometric growth rate or average growth rate formula. Right? Let's do one more question. Little different. Look here, what he gives us, a company has paid the following dividend over the last 5 years. Okay, he gave the dividend for the last 5 years. Estimate the growth rate and the cost of equity if the current ex-div market price is 10.50 per share. Now again, we have to find the growth. So look, we choose the two dividend only, the latest dividend and the earliest dividend, right? We only take the latest dividend and the earliest dividend. So latest over earliest into 1 plus n, 1 over n. How many number of years of growth we have? 5. But no, it's not 5, it's 4. Look, growth is what? This is 1 year of growth. This is 2 year of growth. This is 3 year of growth. And this is 4 year of growth. Growth means how many year of growth you have. Look, in previous question, he didn't say, he said 4 years ago. So simply keep in mind, if we say 4 year ago, 5 year ago, then simply we use n, 5, 4, whatever. But if he give you table like this, then to find the n, you need to see how many growth you have. Count and -1. So we have 4 year of growth here. So if you calculate how much answer you get now. So To find the G, first of all, I have to use the latest dividend over earliest dividend into 1 over 4 minus 1, right? I will get my growth, right? So my growth is, you can check, our growth will be 9.73 R. You get approximately 1.0973, right? The growth is approximately 9.73. Now, can we find the cost of equity? Yes. We find the growth. No, we can apply the cost of equity formula and we can find our cost of equity now. We find the growth and now we can find the cost of equity. So to find the cost of equity, the formula is the latest dividend D naught, which is 145 cent or $1.45. So $1.45 into growth is 9 points, so 1.0973 divided by price 10.50 plus growth 0.097. You will get your answer. Okay, the second approach we have is earning retention model or Gordon growth model. Okay, so Gordon growth model is the second approach that we can use here. And it's totally based on different idea. Formula is G is equal to BR. What does the B means? What's the R means here? Here B is basically means the proportion here. B is earning retention rate, a proportion of the money that you retained, and R is your accounting rate of return. Basically, your R here is ROI, return on investment, right? Normally we call this, or ROCE, right? Your accounting return, okay, or ROI we have to use here, okay? And the earning retention rate is basically mean how much earning you're retaining. Okay, let me explain to you by the help of example. Let's say a company who make the profits for the year, or the company, the profits that they make is, let's say the company profits are, let's say 10,000. The company profits are 10,000. Okay, what companies do, some of the profit they give away as a dividend, right? They return back to the investor. So how much dividend you pay here? Let's say dividend you pay here. Let's say out of 40,000, 10,000, the profit you earn, you pay 4,000 as a dividend, right? So what is the remaining? The remaining is 6,000. What do we call it? Retained profit. The profit that you retained this year, this is the retained profit. So how much retained profit we have? 6,000. Retained earnings is cumulative figure for all the previous year plus this year. This is for this year only. Retained profit means retained earning for this year only. No, basically B is retained profit, but not in dollar value, in percentage. Can we find how much percentage we have? 6,000 divided by 10,000. 6%, 60%, yes, 60%. So that means our percentage of dividend is, by the way, we have earned 100% of the profit. The total percentage is 100%. So out of 100%, 40% we pay out as a dividend and 60% is our retention. So 60% profit we retain. Retain mean what? We haven't give back to the investor. So we reinvest, right? So 60% of profit we reinvest. So when we reinvest at what? We reinvest at our ROCE. Of course, when we reinvest the money, we invest it at some return, which is ROCE. So we multiply with our ROCE and we will get our G, growth. Okay, let's say the B, here we find out proportion of retained earning is 60%. Okay, 60% of the profit we retain. And we retain mean we reinvest at what? At our return on capital employed, which is, let's say, 10%. So we reinvest at 10%. That means we achieve a growth of what? 6%. When you multiply, you will get 6%. Look, whatever profit you reinvest, right? So you reinvest and you will reinvest at a certain profit, at a certain percentage. And whatever you achieve is a growth. So this is the second way, which is based on the idea that if you have the higher level of retention, the higher the potential of the growth rate you have. Simple. The idea is very simple. So let's try question, simple formula, and the formula will be provided to you in the exam. Look, sometime what he will do in the exam, rather than giving out retention profit percentage, he will give you dividend percentage. Like, okay, he will say the company payout, a dividend payout is 40%. Then what mean retention is 60%. Remaining is the retention rate. Okay, now let's try the questions over there. Let's try this question. Look, examiner will not specify in the exam which method to use, either the Gordon method or either the average method. From the data, we will understand how, okay, because the data is given dividend last year, dividend this year, then we have to use the average method here. The data is, look here, what he give you, company accounting rate of return is given. The company accounting rate of return is given. Payout is given. That means what is the B? What is B here? Payout mean you pay out. Mean how much profit you earn, 30% you pay out as a dividend. What is the retention percentage? 70%. Multiply by what? Accounting rate of return, how much? 12%. Find the G. How much you get? Find the G. So 12% multiplied by 30% divided by 100. You have to do it. So what you will get? I think 12 threes are 3.6%, right? Is it? 3.6% or 0.036 is your growth rate. And now calculate the cost of equity straight away. Sorry, I made a mistake. Growth is 8.4%. Sorry. It's not 30%, 70%. Huh? So 12% into 70%. 12% into 7. This is the payout ratio, not the retention rate. B is the retention rate. So 12% into 70%. So 8.4%. Yes, 8.4% is your growth. And now apply this and simply find out the cost of equity, which is what? The cost of equity. To find the cost of equity, the formula is D0, which is 40 cent into 1 plus G, okay, over P0, which is cum div. We have to find X div, $5. Okay, you can find here, by the way, directly minus the dividend payment of 0.4. So you find the X div price and plus G, which is 0.084. You have to do in the end. And what is the cost of equity you find? So if you understand it, we completed one section. How to find the cost of equity using the dividend valuation model. So what's the answer? 17.82% approximately you will get, right? So you should practice it, right? And also practice in Excel if it might come in section C, so you should also be able to do it in Excel as well. Okay. This question is similar, so this is your homework. Again, you have payout, dividend payout ratio is given. That means B is 80%. Return on equity is given. So 80 into 12.5 will give you the G, and then use it to find the K. Okay, the last question here, yeah, using this approach is this. You can try this question. Okay, find the G first. Which method to use? Okay, so how much retained profit percentage? Yeah, it is 60%. Why? Because the company total profit is 100,000 and 40,000 you pay as a dividend. So 40%, 40 over 100, 40% is the payout ratio. That means the remaining is 60% is your B. So the B is 60% here. And then what is R? R is either your ROCE or ROE or ROI, he will give it to you, or you have to find it here. He gave us here any of this? No, he haven't given. So we have to find, right? How we can find? See, he gave you profits, he gave you investment. What's the ROCE formula? Return over profit over investment, or ROI. So 100 over 1 million, how much you get? 10%. Yes, 10%. So what is your G? Is equal to B, 60% multiplied by R, yeah, 10%. So 6%. So we find the G, it is 6%. And now use this in the formula of KE and you will find the cost of it. Simple. KE is equal to D0, which is, look, he might give us dividend here. Look, dividend, one more important point I want to raise here. You can use total dividend as well and divide by total market price as well. Or you can take dividend per share as well. By the way, dividend is not given in per share. You can find, right? How? The total dividend is given. The total number of shares given, right? So total dividend is the total dividend you pay. How many number of shares you have? 300,000 shares you have. Divide and find the dividend per share. How much you get? 40,000 divided by 300,000. How much it is? 13.3333, right? So this is the dividend per share, 13.333, whatever is the dividend, multiply by growth you find, which is 1.06, right? And then we divide it by the market price X div is given 2.7, 2.7, right? And then plus G. Solve it and you will get this answer. Or look, you can take total dividend over total market value. Total dividend is given, by the way. So market value per share is given, multiply by the number of shares, and you will divide, same answer you will get. So you can take dividend per share or price per share, a total dividend divided by total number of total market price of shares. Okay, in both ways you will get the same answer. Okay. Okay, that is the one way to find the cost of equity, a required return of shareholder, a required return of equity holder, RE or KE. Okay, both we can find out using this method.